Well, good morning, everybody, and happy Veterans Day. I'll allow the casual attire today. As you know, those of you that have YouTubed with me before, you know that I do it from the desk of Greg Bodoh once in a while, and it's mostly generated by people who have asked questions. Coming up here on the end of the year, people are looking at their assets, reviewing what they have, they're considering the fear of the fiscal cliff and what that might mean to them and to their retirement income. I've had a lot of questions about REITs as investments because REITs are good income generators generally. So I'm going to break this down into two different kinds of REITs, the traded REIT and the non-traded REIT. I've made these notes this morning, so let me go here. You know, a real estate investment trust is what REIT stands for. Real estate investment trust, REITs, the S is plural. You know, a real estate investment trust combines investor capital to assemble a portfolio of income-yielding properties. Typically, they specialize in various real estate sectors: apartment buildings, shopping centers, healthcare facilities, office buildings, and so on. For the average investor, the REIT provides the opportunity to invest in real estate without the requirement and the encumbrance of owning the physical asset and inventorying it as well. To meet the IRS requirement of tax status that REITs provide, a REIT must distribute 90% of its income annually. Now, it could be more, but it can't be less, so minimum of 90%. REITs are organized in two different ways. There are private REITs or public corporations, and they're differentiated by how they are listed. REITs that are not traded on a national exchange, like the stock exchange, the Dow Jones, the S&P 500, not traded on a national exchange, they're considered non-traded REITs. REITs that are traded on a national exchange, they're categorized as traded REITs, and they are commonly referred to as traded REITs versus non-traded. So let's take the publicly traded REIT for a minute. Well, publicly traded REITs, they have distributions and potential capital gains and appreciation, and the primary advantages of owning a publicly traded REIT is liquidity. You see, additional shares benefit from the same market liquidity as ordinary stocks or ordinary equities. Many investors use REITs for portfolio diversification, since REIT performance has limited correlation to the stock market. Now, that's a good thing. Now, publicly traded REITs are also subject to more regulatory insight than their non-traded counterparts. These tend to provide an investor with transparency, financial information that is more accurate and more detailed. Some think that. I'm not sure I agree with that completely, but I'm trying to give a balanced perspective here. You know, if we move into non-traded REITs, the growth of the non-traded REIT sector has been driven by brokerage firms, stockbrokers, financial advisors looking to diversify their portfolio offerings for their clients. And the principal selling features of a non-traded REIT is it includes yields and anticipated share stability, which is supported by the closed-end nature of the facility, meaning it can't be traded on an exchange, so it only has the value of the real estate contained in the REIT, and it doesn't have the pressure of the fluctuating stock exchange going up or going down. Depending on the issuer, the non-traded REIT may offer untenable dividend distributions and inaccurate variations. This has been borne out by history. However, front-end fees can be as high as 15% of the share price to cover selling expenses, organizational costs, and legal expenses. Some of these problems have led to increased regulatory scrutiny by the SEC and other associated federal agencies. That makes it sound very bad. The good news side of it, non-traded REITs, because of their non-scrutiny of the SEC and other associated federal agencies, have the opportunity to reduce costs and expenses inside the management of the portfolio. So there's two sides of the story there. But despite the history plagued by inconsistent business growth practices, the non-traded REIT sector continues to grow. As a matter of fact, as of January 2011, there were about 60 non-traded REITs registered by the SEC. The current portfolio of these entities totals around $84 billion, and the industry expects to grow by at least 9% over the coming year. The tax treatment of these is very straightforward, whether it's traded or non-traded. Offers a 1099 as opposed to a K1. Those of you that have experienced a K1 really understand the advantages of a 1099. And it allocates dividends and distributions as ordinary income, return of capital, or capital gains.